Welcome back to another episode of Management Accounting. In this video, we are going to learn how to do the multi-product break-even analysis. Here, we are going to cover formulas relating to multi-product by calculating the combined ratios as well as the use of break-even and profit volume charts. Break-even analysis is used by most of the companies for short-term decision making. Break-even point is the point where there is no profit or no losses. This can be found for a single product by dividing the fixed cost by the contribution per unit. If we want to calculate the break-even point in value, what we are going to do, we are going to divide the fixed cost by the CS ratio. CS ratio means the contribution divided by sales. Margin of safety is a financial ratio. It measures the amount of sales that have exceeded the break-even point. It indicates the actual profit of the company once it pays all the fixed and variable costs. It is also known as the safety cushion for future financial losses. To remain profitable, all the companies should have a positive margin of safety. Now let's see how to calculate it. If we want to calculate the margin of safety in units, what we are going to do, we are going to take the actual or budgeted sales units, and from that we are going to deduct the number of units at the break-even point. If we want to take the margin of safety in rupees, what we are going to do, we are going to take the net profit and we are going to divide with the profit volume ratio. Now let's see how to do a break-even analysis for a portfolio of products. When there are two or more products, or if you want to calculate a break-even analysis for a company as a whole, the equations are a bit different. In the case of break-even point in units, what we are going to do is we are going to divide the fixed cost from the average contribution per unit. When we want to find the break-even point in value, what we are going to do is we are going to divide the fixed cost from the combined CS ratio. Now let's see how we are going to calculate the margin of safety for a portfolio of products. So we know that margin of safety can be calculated in units, as a percentage, as in values. In the case of margin of safety in units for a portfolio of products, what we are going to do is from the budgeted sales units, we are going to deduct the break-even units. Here, the break-even units represent the portfolio of products or the combination of products break-even units. In the case of margin of safety in value, what we are going to do is from the net profit, we are going to divide it with the combined profit volume ratio. This combined profit volume ratio is also known as the combined CS ratio. So in this one, you have two products, which is A and B. You have given the selling price, variable cost per unit, as well as sales forecast per month in units. Furthermore, you have given the fixed cost per month. Now from the given details, you are required to calculate portfolio break-even point in units, break-even point in value, margin of safety in units, as well as margin of safety in value. First step is we have to calculate the contribution per unit. Contribution per unit is the selling price minus the variable cost. Accordingly, for product A, contribution per unit is 4 rupees and for product B, it's 5 rupees. Now let's calculate the portfolio break-even point in units. It can be calculated by taking the fixed cost and we have to divide it by the average contribution per unit. Average contribution per unit is the total contribution divided by the total quantity or the output. To get the total contribution, we have to take the individual contribution of each product and then we have to take the addition of it. Accordingly, the contribution of product A is 4 rupees of contribution per unit into its quantity. For product B, contribution per unit of 5 rupees into its quantity of 4,500. Then we have to divide it by the total output, that is 6,000 plus 4,500. Then we are getting 4 rupees and 43 cents approximately as the average contribution per unit. So let's calculate the portfolio break-even point. The fixed cost of the company is 31,000. It has to be divided by the average contribution per unit, which is 4 rupees and 43 cents. So we know that units cannot be in decimals, so we have to round it up. Finally, break-even point for the company as a whole, we are getting 7,000 units. Now, let's calculate the combined CS ratio. Combined CS ratio can be calculated by multiplying the contribution values with its quantities and dividing it with the multiplication of the sales value. So, we know that product A, 6,000 units is there. We have to multiply it with its contribution. Then we have to add the product B units with its contribution. Then this total contribution should be divided by product A quantity into sales value plus product B quantity into sales value. So the total contribution is 46,500 and total sales value is 102,000. So as the combined CS ratio, we are getting 45.588. It's better to put 3 decimal places as the percentage. If not, there is any rounding up error, you may not notice it. Portfolio break-even point in value can be easily calculated by taking the fixed cost and divided it by the combined or portfolio CS ratio. To calculate the portfolio break-even point in values or the combined break-even point in value, what we are going to do is we are going to take the fixed cost, which is 31,000, and we are going to divide it with the combined CS ratio, which is 45.588%. we are getting the portfolio break-even point in value as rupees 68,000. This is easier than the previous method to calculate the break-even point in values. However, if the examiner asks you to calculate the individual break-even points as well as portfolio values, then it's better to move into the previous method. Now let's calculate the margin of safety in units. Margin of safety is the budgeted sales volume minus the break-even point in units. Here, the budgeted sales volume combined together is 6,000 plus 4,500. From that, we have to deduct the break-even point in the portfolio, which is 7,000. So the margin of safety in units is 3,500. Now let's calculate the margin of safety as a percentage. Margin of safety as a percentage is the difference between the current sales value and break-even point in units divided by the current sales level. And then that should be multiplied into 100 to obtain the percentage. So here the current sales levels we have already calculated, that is 10,500. It is the summation of 4,500 plus 6,000. From that we are going to deduct the break-even point in units, which is 7,000. So the difference should be divided by the current sales value. Then it should be multiplied by 100. So the margin of safety as a percentage is 33.33%. Finally, let's calculate the margin of safety in rupees. That is the net profit divided by the profit volume ratio. When we don't have the net profit itself, we can calculate the net profit by taking the contribution and we can add the fixed cost into it. To calculate the margin of safety in value, first we are going to take the combined contribution or the total contribution, which is 46,500. For that we have to add the fixed cost, which is 31,000. Then this has to be divided by the combined CS ratio or the combined PV ratio, which is 45.588%. So the margin of safety in value is rupees 170,000. When it comes to break-even analysis of a portfolio, first what we are going to do is we have to calculate the sales ratio. So there are two products, A and B. So A, we are going to sell 6,000 and for B, we are going to sell 4,500, which means we are going to sell for each 4 units of A, 3 units of B, which means the ratio is 4 to 3. In the next step, what we are going to do is we are going to calculate the contribution mix. Here we have the selling price and variable cost for A and B separately. Now what we are going to do based on this information, we are going to calculate the contribution per unit for A and B. That is 4 rupees for A and 5 rupees for B. Then what we are going to do is we are going to put the sales ratio. We have calculated it previously. It is 4 to 3. Now what we are going to do? We are going to identify based on this information the contribution mix that can be calculated by taking the contribution per unit into sales ratio. So here for product A, the contribution mix is 16. For B, when we multiply the contribution 5 by the sales ratio 3, the contribution mix is 15. So what we are going to take as the contribution mix is 16 to 15. Now what we are going to do under the third step is we are going to calculate the contribution per set. Contribution per set is the addition of contribution mix of A and contribution mix of B. So you know that contribution mix of A is 16 and for B it is 15, which means the total contribution per set is 31. In the step 4, what we are going to do is we have to calculate break-even point per set. That can be calculated by dividing the fixed cost by the contribution per set. So break-even point in set is 31,000 of fixed cost divided by contribution per set 31. Therefore, break-even point in set is 1000 units. Now let's see how we are going to evaluate the portfolio break-even points. So you know that there are two products A and B. So we have calculated the break-even point in set, which is 1000. So we know that the ratio between the two products is 4 to 3. 4 is for A and 3 is for B. So what we are going to do, we are going to multiply the break-even point in set with this ratio. So for product A, break-even point is 4000, whereas for product B, break-even point is 3000. Altogether, it is 7000. So now what we are going to say is to calculate the break-even point in value. For that, we need the selling price. For product A, selling price is 8. And for product B, the selling price is 12. Now what we are going to do is we are going to multiply the break-even point in units with the selling price. So we are getting 32,000 as the break-even point in value for product A and 36,000 for product B. Altogether, break-even point or the combined portfolio break-even value is 68,000. Now, this point onward, we are going to discuss the past papers. Here I am going to discuss the previous Advanced Management Accounting past papers from 2017 to 2022. Now let's discuss the 2017 Advanced Management Accounting past paper. Alpha Limited produces and sells two products X and Y. Following information is related to both products. So here they have given separately for X and Y the selling price, direct material, direct labor, direct expenses as well as the sales units. The fixed cost of the company is 120,000. You are required to find the overall contribution to sales ratio, which means the combined CS ratio, and the break-even sales value in rupees of the company. So here everything is given in detail and you are required to calculate the calculation just for 5 marks. The first step is calculating the contribution per unit. Contribution per unit is the difference between the selling price and the variable cost. So let's calculate the contribution per unit for X and Y separately. Selling price of X is 20 and for Y it's 15. And variable cost for direct material for X is 4 and for Y is 2. And for direct labor for X it's 2 and for Y it's 2. Then we have to deduct the direct expenses. For both X and Y it's 2. Now we can get the contribution by deducting all the variable costs from the selling price. For X, the contribution is 12 and for Y, it is 9. Based on the previous calculation, now let's calculate the overall contribution to sales ratio. This is also known as combined contribution to sales ratio. So combined CS ratio is the total contribution divided by the total sales value. So we have to multiply the contribution per unit for X and Y with its sales units. So X contribution per unit is 12 and it should be multiplied by the sales units of 10,000. And we have to add the contribution per unit of Y with its sales quantity. 9 into 15,000. Then this value should be divided by the sales value. So we are going to take the X selling price 20 into its quantity of 10,000 and we have to add the Y's selling price into its quantity, which is 15 into 15,000. So the combined contribution value, we are getting 120,000 plus 135,000 and the sales value is for X it is 2 lakhs and for Y it is 225,000. Finally, we are getting 0.60 as the CS ratio. In a percentage, it is 60%. Part 2 of the question is to calculate the break-even sales value. So you know when we are going to take the overall break-even sales value or the portfolio sales value for the company, what we are going to do is we are going to take the fixed cost and we have to divide it with the combined CS ratio. Accordingly, the company's fixed cost is 120,000 and it should be divided by the combined CS ratio, which is 0.60. So as the portfolio break-even sales value will be rupees 200,000. Check whether you have get the theory correctly. Check whether you can calculate the combined CS ratio. Check whether you can apply it into the break-even sales value. Now let's look at the Advanced Management Accounting 2019 past paper. It says A Limited Evaluation, the introduction of nutrition cereal packet in flavors apple and mango, which will be sold in boxes of 6 packets each. The details of the two products are given below. So there are 2 cereal packets in favor of apple as well as in mango. Now you have given the details. So you have given the selling price, direct materials, direct labor, variable production overhead to calculate the contribution. Then you have given the sales forecast as well. In the latter part of the question, you have given the fixed production overhead per month and you are required to calculate the combined profit volume ratio as well as the break-even sales value. Since it is 2 marks, we have to just put the formula and we have to do the calculations. The first step is calculating the contribution per unit. The calculation of contribution per unit start with the selling price. For the apple, selling price is 1080 and for mango it is 1640. From the selling price, we have to deduct all the variables cost in order to arrive at the contribution. This variable cost involve the direct material cost for apple and mango, direct labor cost for apple and mango, and the variable production overhead for both products. When we deduct the variable cost from the selling price, we are getting the contribution for apple as 450 and for mango 810. So let's calculate the combined profit volume ratio. So the combined profit volume ratio can be calculated by taking the total contribution and dividing it by the total sales value. The combined PV ratio can be calculated by taking the apple's contribution per unit into its quantity as well as taking the mango's contribution per unit into its quantity. That is 450 into 2000 plus 810 into 1000. Then what we are going to do is we are going to take the sales figure as well. Sales figure for apple is 1080 into the quantity of 2000 and the sales value of mango is 1640 into its quantity of 1000. By doing the calculations, we are obtaining the contribution value of apple and mango as 9 lakhs and 810 lakhs. Then the sales figures are 2,160,000 and 1,640,000. By dividing the total contribution by the total sales figure, we are getting the combined PV ratio as 0.45 in decimals and as a percentage, it's 45%. Part 2 of the question is the calculation of break-even sales value. That can be calculated by taking the fixed cost and dividing it by the combined profit volume ratio. Accordingly, first we have to take the fixed cost, which is 2,086,200, and we have to divide it with the combined PV ratio, that is 0.45%. So the break-even sales value is 4,636,000. Now let's look at the Advanced Management Accounting 2020 paper. This question is about the PQR Limited Company, which produces and sells two products P and R. So you have given the selling price, direct material, direct labor, direct overheads for both P and R separately. Sales units for product P is 10,000 and for product R, it is 15,000. Fixed cost of the company, which means the total fixed cost, is 120,000. So you are required to find the overall contributions to sales ratio and the break-even sales value in rupees for the company, which means you have to find the portfolio break-even sales value. First of all, we have to calculate the contribution per unit for P and Q. For that, from the sales price of P and Q, we have to deduct all the variable cost. This variable cost include the direct material cost per P and Q, direct labor cost, as well as the direct overhead cost. When we deduct all the variable cost from the selling price, we are getting 12 for P as the contribution per unit and 9 for Q as the contribution per unit. The next step is we have to calculate the combined contribution to sales ratio. This is also known as overall CS ratio. For that, we have to take the overall contribution and we have to divide it with the overall sales value. For that, individual contribution should be multiplied with the individual quantities as well as individual sales value should be multiplied with the individual sales quantities. Let's see. So the combined CS ratio is contribution per unit of P into its quantity, which is 12 into 10,000. Then we have to add the contribution from Q, which is 9 into 15. 9 is contribution per unit of Q into its sales quantity of 15,000. Then this should be divided by the sales value of each product. So the total sales value of P is sales price per unit 20 into 10,000. And we have to add the sales value of Q, which is 15 into 15,000. So ultimately, we are getting 0.6 as the combined CS ratio. In a percentage, it is 60%. Check your calculations and check whether you can obtain this value for combined contribution to sales ratio of the overall company. Part 2 of the question is to calculate the break-even sales value. So you know when we are going to take the overall break-even sales value or the portfolio sales value for the company, what we are going to do is we are going to take the fixed cost and we have to divide it with the combined CS ratio. Accordingly, the company's fixed cost is 120,000 and it should be divided by the combined CS ratio, which is 0.60. So, as the portfolio break-even sales value will be rupees 200,000. Check whether you have get the theory correctly. Check whether you can calculate the combined CS ratio. Check whether you can apply it into the break-even sales value. It's time to see 2022 AMA past paper question. XYZ Limited produced two products and the following budget applies for 2022. So they have given product X and product Y, selling price, variable cost, contribution and fixed cost apportion. So rather than the earlier questions, you can see that fixed cost has been divided among X and Y separately. And then they have provided units sold for X as well as Y. You are required to calculate the break-even point for each product and the company as a whole. So separately, you have to calculate the break-even point. Then for the whole company, you have to calculate the break-even value. You know that break-even point can be calculated by taking the fixed cost divided by contribution per unit. Here, break-even point for product X is X fixed cost divided by its contribution per unit. So we are going to divide 100,000 by 4 rupees. So we are getting 25,000 units as the break-even point for product X. Now let's see how we are going to calculate the break-even point for product Y. As same as earlier, what we are going to do, we are going to take the fixed cost which is allocated for product Y, which is 200,000. Then we are going to divide it by the contribution per unit of product Y. So we are getting 25,000 units as the break-even point for product Y. Now let's calculate the portfolio break-even point. It is the fixed cost divided by the average contribution per unit. To get the average contribution per unit, we have to take the total contribution, then we have to divide it by the total quantity. So, what we are going to do is, for individual products, contribution per unit has to be multiplied by its quantity. Then we have to divide it by the total output. Accordingly, average contribution per unit is 5 rupees and 20 cents. So now what we are going to do is we are going to divide the fixed cost 300,000 by the average contribution per unit, which is 5 rupees and 20 cents. Approximately, we are getting 57,692 units as the portfolio break-even point in units. In other words, for the company as a whole, the break-even point is 57,692. This question is for you. X company produces and sells product A and B. The following information is related to the last year. So you have given the selling price as well as the unit variable cost. Based on that, they have calculated the unit contribution. And they have provided the sales quantity for A and B separately. If the annual total fixed cost of the company is rupees 120,000, you are required to compute break-even point in units and value as well as margin of safety in units and value. I have given the solution. Please go through it and do some more questions with regard to multiple product break-even analysis.